Yeah, hello everyone. What we're going to do in this video is that we are going to learn the very basics of options. What is a call option? What is a put option? What is in the money? What is out of the money? What is at the money? And understanding when should you go and buy an in the money or when should you go and buy an out of the money. So we're going to do the very basics in this video. And in the next video, that'll be the second part of this video, is where we're going to jump into option Greeks, which will further explain us that how these option prices move and further increase one's understanding of options. So now let's get started. So when what is options? Actually, options is a derivative. So again, in the word itself, derivative, it is derived from something. So whenever you see an option, understand that it is not the actual asset. It is derived from something. It is deriving value from something. So let's say if I take a nifty option chain, what does the options tell me over here? That it is being derived from the Nifty 50 index. If I take a Bank Nifty option chain, understand the Bank Nifty options are basically derived from Bank Nifty spot. Same thing goes for any stock. If I take Reliance 2000 call option, what does it mean? That's being derived from Reliance prices. However, Reliance stock is going to move is how the option will move, either on the upside or on the downside. That's another story. But the whole correlation, the main factor is the stock itself, like the Reliance stock itself. And in this case, Nifty option that we have open over here, the options will change their price according to how Nifty 50 changes its price. And when we come to options, we have two kinds of options. One is a call option, and the other is a put option. So, what is a call option? A call option, or let's say, let's actually answer two questions together. What is a call option, and when will you buy a call option? So if you're buying a call option, it basically means that you're going long in the market. It's like you're buying a stock. Like when you expect a stock to go up, what do? You buy that stock, right? So the call option is the same thing. When you expect the stock or the index to go up, that's when you buy the call option. And as much as the market will go up, the call option will give you that much money. So call is almost pretty much the same thing as or equivalent to buying a stock. It just has a different term. And put on the other side is basically it's like shorting the market. The more the stock falls or the more the index falls, the more the put prices will increase. So when do you buy a put option? You buy a put option when you expect the market to fall, or you expect whatever asset you're buying off, you expect it prices to fall. And when those prices will fall, that's when puts price is going to increase. So I hope you have noticed this part, that both in call option and put option we are buying both of them. Normally in equity you buy for going long on the market, and you short for going short on the market. But here both the call and put options are being bought, whether you want to go on the higher side or on the downside. There's another possibility here that you can sell a call option and you can sell a put option. So understand, when do you buy a call option? When you're bullish on the market. So when will you sell a call option? When you're selling a call option, it's basically the opposite. That means you're bearish on the market. And now there's another doubt that you might have. If I'm bearish on the market, why should I sell a call option? Why not, buy a put option? And these questions are what's going to be answered in the video, are going to be answered, in this series at the later part. Because right now, if I tell you why, you are not going to really understand it because you don't know the foundation. This foundation is all going to be built in this video and the coming videos. So the same way, you can also sell a put option. So what happens when you sell a put option? That basically means that you're going long in the market because you're selling a put option, right? You're not buying a normal put option. So there are four ways how you can take a transaction in options. One is buying a call, or you can sell a call, or you can buy a put, or you can sell a put. So what are the two bullish ways? Either you buy a call or you sell a put. Both these ways are going bullish on the market. And how are you going short? Either you sell a call or you buy a put. All right, so that's like the very basic about what is a call option, what is a put option. Normally, when you're going through your, whatever broker you're using, normally it's written as CE and PE. Call option written as CE, and put option is written as PE. So the 16,800 is probably going to be written as 16,800. Let's say you see over here 16,800 C. C and P are the terms that's used. So now that you've understood what is call and put option, let's go to the second basic thing that one needs to understand, and that is moneyness of an option. whether an option is in the money, at the money, or out of the money. So again, now I told you, right, that an option, uh, let's say a call option. What does a call option tell us? That the market is going to go above. So where is Nifty 50 right now? Let's look at Nifty 50. Can you look at Nifty 50 over here? It's at 16,842. All right. And okay, so just before I go into that, I'll just briefly explain you how the option chain is normally, uh, displayed as. So this is Sensible's option chain. Anyone can access. Anyone can. You don't have to be a zero the user to access it. You can have any broker and still access it. So when you open a option chain of this kind, on the left side you have the call options, and on the right side you have the put options, and the middle is where the strike prices are kept on. So how are these strike prices related? Let's say now Nifty 50 is right now at 16,842. So wherever Nifty is at, right, that's what I want to call as spot price. Spot price is the real assets price, and whatever option are we going to buy, all of them are going to have a particular strike price. That is where do we expect the market to be at the end of expiry. So let's say in this case, now if you see there's yellow over here and there's yellow over here. These 2 points, it's white over there, but understand that why is that over this line? Why is the whole thing not yellow? So this is where the market is right now. So in just a glance, you'll understand where the market is right now when you see what is the convergence between these four. And it's at 16,800, right? Where did our Nifty end today? 16,842. So what is the price right now that is on the strike? 16,800 is where the market is right now. So understand, if I'm buying 16,800 CE right now, all right, you need to question yourself in either, right or wrong. So let's say I'm buying 16,800 CE right now. So what does it tell me? Is the market above 16,800? C is long option. C is when you're going long. So you want the price to be above the strike. So if it is 16,800, and where is the market right now? It's at 16,842. And what option did we buy? A long, we are talking about call, 16,800 CE. So is the market right now above 16,800? Yes, it is. It is at 16,842. So that means that the stock is in the money. Now again, in the money, there are at the money is basically a variation of in the money. What at the money tells us is that this is directly at spot. 16,800 is the strike price over here. And what is the spot? It is 16,800. So this is directly at the money. Now understand, above this, all of them are in the money. And I'll explain it, don't worry. So again, the question I need to ask yourself is whether it's right or wrong. Let's say 16,700 CE. So break it down in two ways. 16,700 CE. What does CE tell us? CE tells us that we've gone long on the market. So ask yourself, whenever it's a C, ask yourself, is the market above 16,700 or whatever the strike price is? Is the market above 16,700? Yes, it is. That's 16,842. So that's why this is in the money. The same way, the same question you ask any more above, it's always going to be correct, right? It's always going to be right. Like, yeah, it is above 16,500 or 16,250. So whatever is correct in this option is basically in the money. And what is at the money? At the money is exactly where the spot and strike are almost equal. All right. Now, but let's go to the lower part. 16,850. So 16,850 C. Again, you ask yourself the same question. Is the market above 16,850? Is it? No, it's not. It's at 16,842. So when you get the answer as no, that's when you understand that the option is out of the money. It has not been correct yet. So, and the same case will be for everything above, right? 16,900. Is the market above 16,900? It is not yet. So that's why it's out of the money. And it's the same thing for everything over here on the downside. So you'll understand that this yellow side, right? So this yellow side is basically all the in the money call options, and this yellow side over here is all the in the money put options. So I told you, I gave you the scenario of call option. Now let's do the same thing for put option. Again, let's come at our right where at the money point, 16,800. So So let's do it. We just have a 16,850 this time. 16,850 PE. What does PE tell us? PE put option, C is call option. What does 16,850 PE tells us? So here we're going to ask the question different, because PE means that you expect the stock to go down. So you ask, is the market below 16,850? And the answer is yes, the market is below 16,850. It's at 16,842. So that means that this option is in the money. And because this is the very first option that's in the money, it's also known as at the money. Now see above that, 16,900, 16,950. All of these are, I'm asking for the P side. So is the market below 16,900? Yes, it is. So that's the reason why it's in the money. And it'll be true for everything above it, right? Because it's common sense. It's always going to be below it. But now again, let's go to 16,750 and 16,750 P, 16,750 put option. So is the market below 16,750? The answer is no. 60 is that 16,842. So again, you get the out of the money range for the put option. So everything above that will also be put option. Everything above that will also be out of the money for put option, because you're asking the same question. Let's say 16,600. Is the market below 16,600? No, it is not yet. So that's why it's out of the money. It's not even come there yet. So again, these are the three types: in the money, at the money, out of the money. And later in the second video, we'll understand why it's very important to understand when to buy in the money, when to buy out the money, or to buy uh, out of the money. It's mainly because of two components. One is delta and the other is theta. Again, now if I'll tell you, you're not going to understand. So we'll do that in the second part of this video. But I think that's it for this video. To sum it up, there are two types of option. There's a call option, there's a put option. When do you, if you want to go bullish, if you're bullish on the market, what do you do? Either you can buy a call option or you can sell a put option. Because when you're selling a put option, you're basically going against it. So a normal put option is bearish. So when you're going against it, it automatically becomes bullish. The same thing. What do you do when you're bearish on the market? You either buy a direct put option or you sell a call option, which is again the same logic like I told you of the previous just like 20 seconds back. Then we come to in the money, at the money, out of the money. A very easy way to understand this is questioning this whatever the strike price is. Let's say that there's a 16,600 call option. Is the market above 16,600? Whenever it is call option, you would ask, is it above? If it is, then yeah, it is in the money. But if the answer is no, it is out of the money. But when it is a put option, you ask the question differently. Is the market below whatever strike? If it's 16,800, is the market below 16,800? No, it is not. So that is why it is out of the money. But if it is, then it is in the money. And the first in the money strike price is what we call as at the money. So yeah, that is it for this video. In the next video, we'll be talking about option Greeks. How does option prices move? And if you wanted to buy an option price, what are the 2-3 things that you need to see before buying an option price? So I hope you learned something new. And if you did, please subscribe to my channel. I think there is around 67 or 67 to 70% of my viewers who are not subscribed to my channel. So please do subscribe, because that is something that motivates me to make more videos as such. So thank you for watching, and I'll see you in the next video.